Hey everyone, and welcome back to another video for today. It was a busy day. Lots of companies did report their quarterly figures. OSCR was one of them. Novo Nordisk, Walt Disney, Shopify, Uber were the others. We did do a whole live stream covering Uber and a bit of Shopify as well. Did already a video about Novo Nordisk that will be in the top right corner. Thursday before the market opens, I will go live with a couple of new guests on the channel to cover Nebius earnings report. So stay tuned for that. Now, OSCR, as you know, is already in the portfolio. It's in the invest and then investigate type of phase for me. And I will be buying more shares after the earnings report and the call that I went through. I noted a couple of things down and I'll explain why. I know the risks. It's still also a very small position in the portfolio, less than 2%. But I do think that if you trust management enough, and especially viewing the track record that they have, and the track record of the CEO as well, because he's been in industry for quite a long time, looking at the growth possibility and probability of this business, market cap wise, we are still here at $3.5 billion. This is a company that is still expected to grow quite rapidly. As you can see right here, yes, revenue 10.9% forward 2 years compounded, but you don't have to take into consideration the market. By the way, these are analyst expectations, right? The market's anticipation of the possible revenue hit from the subsidies that will expire and all of that. But if you look at EPS, and by the way, we'll talk about all of this later in the video because management did provide us with some 26 guidance and comments on that 2027 guidance as well. So if we look at EPS growth, EPS expected to grow much faster than that. Now, of course, we already got the preliminary numbers a week or so ago. So nothing really surprised us today. And that's why the stock was up 3.8% today, because the worst case scenario was already given last week. What was said today during the call is the reason why the stock actually went up, despite the medical loss ratio being down. Being up, but down meaning it's worse than before. The comments for the future of the company were quite reassuring. And as you know, you invest in the future of a company. And I do think that OSCR's future is quite a good one. Yes, there are some obstacles ahead. And here as well, you will need some patience. But I do think that for a company of this size, playing in a market as big as the health insurance market in the United States, to me, it was worth having that invest and then investigate type of mentality. And I'll explain throughout the video why I become more and more comfortable owning this name. If you enjoy this type of videos, hit all the buttons. We really appreciate that. Share your thoughts on this holding. Did you buy? Did you sell? Do you hold it? Let me know down in the comment section below. If you want to support me even further, do check out the link down in the description and end up in comment to the top 10 best stocks to buy now, or go to fool.com/coachinvestor. Thank you very much. All right, so first up, revenue for the quarter came in at $2.8 billion. That's still up 29.5% year over year, but down a little bit from the previous quarter, which was $3 billion. Then looking at the other numbers, again, nothing here should surprise you. So if we look at medical loss ratio, 91.1%, much higher than what it was same quarter last year, 79%, and 6 months ending were at 83%, which again, if you compare it to, let's say, United Health or something, for a company the size of OSCR, 83% or even 79% was very good. SG&A expense ratio, still pretty good, 18.7% here, and then of course, losing money. Then if you look at the full year guidance, which again, they gave us a week or so ago, here at the top, that was the previous guidance that they gave us. So they expected previously total revenue of $11.2 to $11.3 billion for the year, and medical loss ratio between, let's call it 81%. Let's say 81%. SG&A expense ratio around 18% here as well. And then earnings from operations to be $250 million. Now the revised one is, the upside here is that revenue is up, right? They now expect $12.1 billion. Previously, that was $11.2, $11.3 billion. So that's good. But medical loss ratio is now expected to be 86.5%. So that's quite a big increase from the previous 81%. SG&A expense ratio, still good here, between 17.1 to 17.6%. But then again, the negative here is loss from operations, not earnings from operations, but a loss from operations. And again, we've seen that across the board, whether it's United Health, whether it's Centene, or the others. Well, we know why that is: higher morbidity in the United States. Now, on the flip side, we wanted to hear more about, okay, what are they doing to make sure that 2026 is going to be a better year, and what's going on with that 2027 guidance? Well, they gave us quite a lot of information actually. So, the company's expectations of a profitable 2026 is based on a multifaceted approach. The company has resubmitted its 2026 rate filings to reflect increased morbidity, anticipating double-digit rate increases. It's funny because remember when we talk about AMD, we always said, oh, well, what does high double digits mean? An analyst actually asked it, double digits, what is it, between 10 and 99%? And I found that quite funny because everybody has the same question. But okay, that's just how you talk again during the earnings call. These filings also account for program integrity changes and the expiration of enhanced premium tax credit. All of the changes that this company is making, all of the assumptions and projections are very conservative, are taking everything into consideration, right? You think that, oh yeah, but what about this thing that will happen? What about that thing? And that will impact them negatively. They're not stupid, okay? They're not stupid. The CEO has quite a lot of experience in this industry. This company knows what they're doing. And so the guidance and everything that they are making right now, the changes that they are making, are taking everything into consideration. Very important to know. Then, OSCR is undertaking measures to reduce administrative costs by approximately $60 million for 2026. This includes workforce reduction and leveraging technology and AI for greater efficiency. Management believes the individual market will stabilize in 2026, which will help address current morbidity pressures and the effects of program integrity efforts. Then, the company has built conservative assumptions into its 2026 projections to account for potential shifts in market morbidity and the impact of program integrity. Again, smart people. As for 2027, the company is reaffirming its 2027 target of 5% margin and $2.25 EPS, which means around 6 times earnings right now, growing quite rapidly. Now, these targets will be reassessed as the company progresses through 2026 pricing season and observes membership development. OSCR is accelerating its effort in medical cost management and deploying AI to improve clinical operations, which are key to achieving these long-term goals. Then, as for other specific data risk adjustments, so in this case here we have a CMS, which is Center for Medicare and Medicaid Services. So the final risk report for 2024 was approximately $23 million favorable to accruals as of 2025. This suggests that OSCR's own financial projections were more conservative than the final data from CMS. CMS data indicates that approximately 2.5% of OSCR's memberships, which is just under 50,000 members, are dual eligibles, meaning they are potentially moving back to Medicaid. OSCR does believe that this percentage is consistent across the market, so they're not surprised by this at all. And again, all of it they have considered when they gave us some future assumptions and guidance. OSCR noted that its technology platform is one of only 11 CMS-approved solutions for creating a digital storefront for all health products, highlighting a competitive advantage. Then, going back to 2026 pricing strategy and cost reductions, they have resubmitted 2026 rate filings in states covering almost all of its current membership to reflect recent increases in morbidity. The relationship between them and the states, they said, are pretty good. Pricing-wise, shouldn't really be any pushback from the states, and they are quite competitive on average in all of the states as well. The company does expect double-digit rate increases in the market. OSCR believes that regulators have been receptive to its pricing rationale. And then, of course, the impact of expiring subsidies. So, the expiration of enhanced premium tax credit is a significant factor for the company's outlook. OSCR's initial 2026 rate filings already factored in the expiration of the enhanced tax credit. The company had previously projected an 18% reduction in its book of business due to expiration of subsidies, but now believes that that number will be higher. OSCR sees potential for upside if the enhanced premium tax credits are renewed in the upcoming continuing resolution, which would alleviate some of the pressure on membership and utilization. The company's revised 2025 guidance anticipates higher market mobility and a modest increase in utilization in the fourth quarter if the enhanced premium tax credit are not extended. Makes sense when something will end, no matter what. But in this case, of course, in health insurance, but no matter what, when you know that something will end, right, one of your benefits will end, of course, you will make sure to take advantage of it before the end, which also here has a negative impact on companies like OSCR, but the whole industry here as well. But the most important parts for me are, again, bottom line, they anticipate and they thought about every single thing here. They gave us some guidance. That guidance, the outlook is conservative. They are very confident in their own strategy. Going back to profitability in 2026, margins should expand in 2026. That guidance for 2027 still remains unchanged. Let's see what happens in 2026. That's something that they said as well. We'll see, we'll reassess the situation in 2026. But so far, it has not changed. And so far, I do think that this is a company that knows how to navigate these muddy waters quite well. You know who this reminds me of? This reminds me of SoFi when they had to operate their business with, I'd say, two hands tied behind their back. They did it very, very well because they had an excellent management team. And I do think that here with OSCR, we can say the same. I'm fairly new covering OSCR, fairly new knowing about the management team and their, well, quarterly, let's say, calls and the way that they answer the questions. But from what I've seen and read up until now, I am growing more and more comfortable having this position in my portfolio, but it still is under 2% allocation at the moment. And that's fine with me because I do think that I will have time to accumulate more and more. Looking at the stock right now, on the weekly, you can see that for the past, almost a month now, the stock has been in the same range, right? It went to $13.50, bottom there, and then we went back up, went back down. So it's been in that range for quite a while. Of course, we had that period where we went here to the $20 or so. There was a lot of hype around OSCR, around Zeta as well. By the way, Zeta, amazing quarter. So congrats to all shareholders. Amazing quarter by Zeta. Still view it as cheap and actually still view it as an acquisition target. But in the meantime, congrats to all Zeta shareholders. If you want a maybe new video, update video about that, do let me know in the comment section. But as for OSCR, I'm quite happy to continue to accumulate here around this range, $14 or so, because if 2026 is truly the year that they go back into profitability, and then of course once we end 2025, we'll get the outlook for 26, and let's say the outlook is even better than expected, 2027 guidance is probably going to remain unchanged, but that's still going to be quite good, $2.25, 5% margin. The amount of revenue remains to be seen what they will do there. But yeah, the fun has not started yet with OSCR. I think the market cap, the industry that they play in, the market, the execution here, management team, the growth potential, you put all of that together, we might have here a potential multi-bagger for the future that of course comes with risk, and you just need patience to see how this thing plays out. I don't expect this to 10x tomorrow or next year, in the next 2 years. No, let it play out. Everybody wants a 10x, nobody wants to wait for it. But I do think it's worth waiting for a 10x return, even if it takes a couple of years' time. I mean, it's quite crazy that I have to say this, but yes, 10x's usually take some time. So all in all, that's about it. Very bullish on OSCR. You will accumulate accordingly. I will be buying more shares in the coming days. All in all, that's about it. Share your thoughts down in the comment section below. Hit all the buttons. We'll see each other in the next one. Bye-bye.